They are all in the economy, and they all like know what's going on. And they all also have a lot of money to lose. So they're paying attention to this a little bit more money, a little bit more than most people, right?
I don't know about a lot of money to lose.
Okay, let me rephrase that.
I don't have money to lose.
You have a lot of debt that needs to be paid. How about that? You guys have a lot of debt that needs to be paid. And so you're trying to get ahead of that. So with that being said, if you guys want to give us a quick intro, I've got a couple questions here for you guys. Just write down what you guys, trying to keep it under 10 minutes, 5 minutes. Just give us a quick little tidbit about yourself.
Hi. Hi, Jason. My name's Dakota. I've been investing for 10 years. I'm about to have my 10-year anniversary and work anniversary in February. This is pretty much the only thing I've done with my life. I don't know how to do much more. But if it's real estate, I've at least dabbled in it, enough to be dangerous. So I've got probably just shy of 300 units in my portfolio. I've never done any syndication. Just done it myself. Rarely taken a partner. Flip houses on the side, maybe 3, 4, 5 houses a year. That's fun. Mostly to keep my wife busy from buying more expensive things.
When the house is cheaper.
Yeah.
That's a big statement there.
I like hard money lending. My long-term plan is I don't want to be in the multifamily space for too much longer. Whenever the powers that be dictate that it's a good time to exit from the multifamily space, I will. I want to get into hard money lending full-time and new development projects. I think that's really, really fun if you've got the right connections. Over the years, we brought our own construction in-house. So we've got a construction company, a management company. I do a lot of nonprofit work, a lot of charity. Sorry, he said 10 to 15 minutes. Normally the intro is like 30 seconds. But we've got 15,000 girls out in Nepal. We started a charity 8 years ago and have grown it in the third world. That's very, very difficult to do, especially in a region that's so geographically difficult with all the mountains. But we've grown to 15,000 girls out there. We have a couple physical schools that we built out there. And that takes a lot of money to sustain, when you're feeding 15,000 people once a day and making sure they get notebooks and transport and uniforms and backpacks and all the logistics that comes with carting those things around a country that hates their people. So that's a big reason why I haven't retired yet. That takes a lot of money to sustain. But overall, I like real estate. I like that it's real. I like that I can touch it. I've done a lot of hotel conversions, buying hotels. My wife and I, we don't have kids yet, so for a long time, we would just buy a hotel, move into it, fix it up, turn it into an apartment, move to the next hotel. New city, new state every time, so that was kind of fun. And one quirky fact about myself, I can put my legs behind my head. How about that? You have to pay extra for that.
Come on, guys. We'll get a going here in a minute. Somebody got a hat? Can somebody pass a hat around? Let's get that going. Yeah, absolutely. All right.
Hello, I'm Russell Hunt. I own Private Money OKC here in Oklahoma City. I do hard money lending. I have been doing commercial. I've been doing real estate for 30 years. I've been doing commercial for about 20. I converted to completely commercial about 12 years ago. So all we buy now is commercial. Like Dakota, I've done just about everything in real estate. Any type of asset class, I've tried it at some point or another. And now I've pretty much do lending, I would say 75% of the time, and manage property 25% of the time. And both of those don't take a lot of time. So that's, I don't do near as much as I used to. I've definitely slowed down a lot, but I still do a lot of lending, and then I still manage our properties. So that's my story.
So I'm Rockford Steel. I'm the owner of Open Path Lending. We're a commercial loan brokerage. I am also licensed for traditional, like conventional FHA, VA type lending as well. I don't do very much of it because I understand the underwriting on that side. I know how it works. I was good at it, but I hate it. you can understand how it works and still not like it. I mean, when you have a real estate investor that has 300 properties that can't qualify to buy a personal home, there's a problem there. So going backwards, my background education is in economics. So, the whole interest rates and inflation stuff, while it's been terrible and it's been rough, it's also been intellectually fascinating for me. So I've been geeking out on it a little bit. And let's see what else. Yeah, I also buy rentals. I tried flipping houses. I'm not good at flipping houses. I'll stick to rentals.
All right, guys. Well, let's get into it. Okay, I don't know about you guys, but the thing that's on my mind the most right now is interest rates. I mean, are they going up? Are they going down? If you guys could rub your little crystal ball there and tell me, with the presidents coming up, all the stuff that's happening. I don't know about you guys, but during Trump's last time he was in office, I made more money than I'd ever made in my entire career. Part of that was the fact that I was a buy and hold investor, and that the inflation happened, and so a lot of my little South Side houses that I bought for $30,000-$40,000 that were worth $50 are now worth $150, and so a lot of that happened over the COVID period. So, what could you suggest, or whatever? What do you sort of see happening in interest rates, and sort of not just the apartment industry, but sort of in the homeowner for like the fix and flips, and then the landlording side from each one of you guys? Sort of the same question.
So if you guys will all agree right now not to listen to anything I say, I'll share what I'm thinking about with you. It's the longer that I've been doing business, the less I feel qualified to talk about it, which is maybe an oxymoron. But and I'll probably leave a lot of this for Rockford, because he's probably the expert. But I think that two things that are on my mind right now. The first is I think that there's at least a significant chance that we'll have a different chairman of the Fed under Trump. I mean, we were just talking about this. Yes, Trump has said he's not going to push Powell out. Powell said he's not going anywhere. They've both done a lot of lying. But Trump hasn't liked Powell since the very first day that he put him in that seat. And Powell's had an extremely rough last 6 to 8 years, where not only has he presided over all these massive rate hikes, but he got beat up the last time Trump picked a fight with China, and there's definitely some more of that coming. If I were in his shoes, I would be feeling pretty tired. So, and especially just if you're signing up for another 4 years where your president doesn't like you and is not going to be shy about twisting your arm. I would bet he's on his way out. So what that means, I don't know. I mean, what it does mean if he's out is that Trump's going to appoint somebody else. And I would guess that one of the hallmarks of Trump's first presidencies is he really didn't know what he was doing. He won the presidency, but he didn't really have those connections. He didn't know who to put in office. He was new to politics. He didn't know who to appoint. So he was taking a lot of advice to people about who he should utilize. And not all that advice was actually good advice. A lot of the people that he appointed ended up fighting him for the rest of his presidency. And this time he knows. I mean, he knows at least more than he did last time. So I would imagine whoever he's going to appoint is somebody that's going to be more amenable to what he wants to do. And I imagine that he's lost 40% of his net worth since he was elected the first time, right? I imagine that this second time, where he's not running for re-election, he's going to be looking to get some of that back. I would guess that those policies are going to be favorable to real estate. I don't know. But there will be basically an entirely new Fed chair, if that happens, which is completely new policy. Now, we were talking about this. I did nothing but complain about Jerome Powell for 6 years. I mean, he just lied through his teeth, right? Inflation's transitory. It's only 2%. We're not going to raise rates at all until 2023.
I don't think he was lying. I think he believed it.
Well, I think the best lies are the ones we tell ourselves.
Quote of the day.
But whether it was intentional or not, everything that he said for a good 4-year period was not true or did not come true. But now we're here, hindsight's 2020. Now we're here, and we actually can say he actually did a pretty good job.
Last year and a half, he's done a great job.
He's not even an equatorist. He's an attorney.
Right. Yes, things are expensive, but they were always going to be expensive. There was nothing that was going to change. Things have kind of stabilized. We are still grappling with the new prices of things, but things have basically done their job. They're not going up 30% a year anymore. They're not going up 10% a year anymore. So he's done a pretty good job. The big thing regarding interest rates that I think nobody's talking about in relation to the next presidential election is foreign policy. The reason, my belief at least, is the Fed keeps cutting rates and mortgage rates keep going up is that the rest of the world has seen how irresponsible we are fiscally and have seen what we've done to Russia, locking them out of our banking system and a whole host of other things. And they've decided, hey, we're not buying your treasuries anymore. We're not buying your bonds anymore. And so China, Japan, Russia, India were some of the biggest purchasers of our bond. And we had our last bond open house here about 2 months ago. And they didn't buy any. Like China, I think, didn't buy one bond. And there's a couple reasons for that. I mean, the obvious reason is nobody wants to buy a bond at 4% if they think inflation's 5%, right? Nobody wants to sign up to lose 1% of their money. And everybody that we're the world reserve currency, so they're actually more in tune with this than we are. They're looking at our banks, how all of our banks bought these bonds at 2%, okay, that aren't worth anything. They're worth less than they bought them for, because if I have a bond at 2%, if I spend $100 on a bond at 2%, and I've got to convince Mr. Allen over there to buy my 2% bond because I need the money, but inflation is 5%, what do I have to do to get him to buy that bond? Discount it. I have to say, you're not going to make any money on the hold, so I've got to make you money on the buy, so I'm going to sell you this bond at $50. That's the only way Allen is going to sign up to buy that bond. So our banks are in absolute crisis, and Americans don't care at all because we're ignorant. We're just stupid and purposely uneducated. But the rest of the world lives and dies on our currency, so they're painfully aware of it. So they don't want to buy our treasuries. And the second part is there are countries out there these countries are clearly gearing up for at least the possibility of a conflict with the United States, right? Like, if China doesn't invade Taiwan the week before Trump takes over, I'm just going to be floored. But they're watching what we do with Ukraine, and we're watching what we do with Russia. They're already trying to destabilize our financial system. And so what not buying our bonds does is it gives China and these other countries a tool of leverage with the United States, right? Because they have to keep discounting our bonds to get people to buy it. Or, sorry, the opposite. They have to keep raising the price of our bonds to get people to buy it. So every time nobody buys our bonds, they go from 4%, they go to 5%, they go to 6%, until they reach a price which our own investors want to buy them, right? And what's a good return for you guys in this room? What would motivate you to go put your money somewhere?
12%.
Okay. So if bonds go to 12%, what is our interest rate in this country?
A lot less than that.
Yeah, 14, 15%, right? So that's the problem. So if China thinks there's going to be a conflict, or Russia thinks there's going to be a conflict, they're going to hold our mortgage market hostage, because they're going to say, when the negotiations come, hey, we'll start buying your bonds again if you do this. Or if you don't do this, we're not going to continue to buy your bonds. And Trump's going to have to contend with that. I don't know what he's going to do. I know he doesn't like China. I know we've got wars on the horizon, but I think that foreign policy is going to have a lot more to do with our interest rates than people think about. And I would say a note of hope for the future, I think Trump's foreign policy was excellent. Maybe it just looks perfect compared to Biden's. But we had no wars for 4 years. We had peace in the Middle East. We had, North Korea chilling out, and within months of Biden, we had another war. We've got North Korean troops into the Ukraine. We've got another war that's looking at starting in Taiwan. It's bad news. So I would say
may not have liked how the optics of what he was doing, but it worked.
Yeah.
Well, might not like the way he said it.
Yeah. Yeah.
So that's my spiel. I'll pass it off.
Well, we were talking about interest rates, and I'll defer that to Rockford because he had a really good explanation on interest rates yesterday. So,
All right. So for interest rates, particularly mortgage rates, a lot of people were confused because the Fed said, hey, we're lowering the Fed fund rate by 25 bips, 25 basis points, or 0.25%. And then mortgage rates went up. And so a lot of people were confused. I got a lot of phone calls saying, "Hey, what do you mean rates are higher today? I thought the Fed lowered the rate." Like, so that's hence my post in the Breakfast Club and on Facebook saying, "Hey, this is what happened." But part of the announcement, the Fed was announcing a change in their projection. So they were previously projecting 4 rate reductions over the course of 2025. I had already kind of expected that they were not going to do 4 rate reductions. They're not going down a whole percent over 2025. It wasn't going to happen. But they formally announced it after the most recent meeting that, hey, we're probably only doing 2. And since mortgage interest rates follow the bonds, which is a market-driven instrument, the market had already baked in and planned on those 4 rate reductions. So when they announced that they're only doing 2 instead of 4, all the bond rates went up. So mortgage interest rates went up probably about 0.25% if you're watching closely on Thursday, I think it was, when the Fed lowered rates by 0.25%. So what the Fed fund rate going down does do is the Wall Street Journal Prime Index is now 25 basis points lower, so bank interest rates will now be 25 basis points lower. So if you're getting bank money for your deals, your interest should be a little bit lower for your new loans. If you're doing long-term fixed notes, the interest rates just went up a little bit. Going up a little bit, I mean, I'm still quoting in the 7s, whether it be like 7 1/8 up to like 7.875. I quoted a couple guys in the 8s, but their credit wasn't so great.
And commercial, right?
Yeah, commercial lending on 30-year fixed.
I think one of the things that I think on short-term rates, they will go down because if you're doing a 1-year loan, the funds rate makes a difference. If you're doing a 30-year fixed rate loan, you've got to look a lot farther out, and they usually match that to the 5 or 10-year Treasury, depending on how long they plan on keeping that loan. So if you make a 30-year mortgage, the average mortgage used to last 7 years. It probably doesn't anymore.
Average age is now 8.
Is it really? Well, that's closer than I thought it'd be. So if you figure you're going to hold that loan for 8 years, you got to make a different strategy than if you think you're going to hold that on commercial paper for a year. Because if you have a 1-year balloon, you don't have to worry about interest rates as much long term. If you have a longer term mortgage, obviously you have to be looking more long term. And I think over the long term, I think the interest rates are going to have to go up because, as Dakota was saying, nobody's buying our bonds. The only one's buying our bonds is the Fed. And as long as the Fed buys our bonds, then that causes inflation because they have to print the money to be able to buy the bonds. So over the course of time, we're going to have continued pressure on inflation because we have to continue to print money. As the interest rates are higher, more money we have to print to cover it. It's going to be harder and harder.
There's also a lot of uncertainty right now because in the campaign, Trump was announcing he's doing all these tariffs. There's going to be all these tariffs, and tariffs are inherently inflationary.
And so are tax cuts.
Yeah, so are tax cuts, and he's announcing he's going to do both
at the same time.
At the same time. So I agree with Dakota. I don't know why the Fed chair would want to stick around. He just got through another.
Well, and that's the other thing is well, and pretty much every administration, but especially the Trump administration, is going to be completely opposed to whatever the Fed does. And I mean, they're going to be fighting with each other constantly. And the Fed really can't fight for themselves because he doesn't have the opportunity to be able to talk like the president does. So the president's going to be attacking him, and whoever's the Fed chair, whether it's Jerome Powell or somebody else, can't really defend themselves.
And Trump cares a whole lot less this term than he cared last term.
True.
I think that this is a bold prediction, I guess. I feel like this is more likely to happen than the opposite, but I'll be the brave one. I'll plant my flag here. I don't think inflation is going to make you guys money this time around. Everybody is sitting here hoping for the Trump train to come through, hoping for the money printing, thinking that it's going to drive your asset values up. And one thing that's been rattling around in my head is that who's going to get the money this time? See, right, in COVID really wasn't driven by money printing. Money printing was one of 4 things that happened in a perfect storm that drove your asset values up, right? One, like rents nationwide were not where they were supposed to be. They were actually low. That's the first thing. The second thing is we actually had a generation coming of age in a period of time where wages were rising. Okay, wages rising is a big part. Debt in general was lower. We actually did have a short supply of housing, which we don't have a housing shortage today. I don't care what articles you're reading are saying what. We don't have a shortage of housing in America. In fact, there is literally absolutely no doubt of it that we are going to have a housing glut 10 years from now, because every year for the next 10 years, we're going to lose like a huge percentage of our population to baby boomers dying off. So you had this perfect storm that caused your asset values to jump. And it wasn't just that they printed money, it was that they were giving it to average people in the economy, okay, which probably isn't going to happen this time around, right? Like my handyman got $180,000 from EIDL money and had never made six figures in his life, right? The payroll protection program put a lot of money into average business owners' hands. The employee retention credit put another $40,000 in your average small business hands. So like, inflation and printing has still been happening, but you guys haven't seen the money right now, right? Because it's going to our defense contractors. It's going to our lobbyists. We're still getting inflation. So here's what I wonder. I say, okay, they open the printing press. There's no way they don't open the printing press, because any intelligent person would start printing money right now. Yeah, it's great. Like, I'm glad that they gave us Doge and Elon and Vivek. I'm glad that they at least gave us the medal so we can feel good about ourselves, but really, what can they cut? I mean, you can say a lot, but the government spending is the only thing that has propped our economy up at all. So either way, they know where we're heading. They know the United States is on the verge of bankruptcy, and the question they have to ask themselves is, how do I want to spend my last 10 years of retirement? Okay, we crossed a major threshold where 100% of our country's GDP cannot sustain our interest. So if you have a $100,000 credit card and you've only drawn $40,000 of it, and you realize that a working full-time 100% of your hours, you can't even pay your interest, and you're going to declare bankruptcy, what do?
Max it out.
You max it out. You max the rest of the card. So yes, your asset values will go up on paper, no doubt about it. But my question is, who has the money to buy it? Right? I've been a millionaire on paper and had to ask my parents for money to pay some of my bills. So I like acutely understand that net worth is fake money. And my asset value, my apartment complex might go from $3 million to $5 million, but if there is no money in your average person's pocket to buy that asset from me, it does me no good. So I have to ask, if for asset values to go up, of those four things that created a perfect storm, what do we have going for us? Do we have money in the average person's hands? Can rents go up?
No.
Have you guys talked to your tenants lately? Can rents go up? No.
Not at all.
They can't go up. You know, are wages increasing? No, they're not. They're going down. Wages are going down, okay? Again, I don't know. I see every day that what they're saying. I'm just not seeing that, okay? I post a job opening for $16 an hour, and I have to, roll my eyes and sit down to do it because I have so many applications, I can't wade through it, okay? And I'm getting applications from people that should not be applying for $16 an hour. These are $22, $24 an hour people, but there's more people fighting for less jobs, so wages are going down. So I worry about that. I'd be interested to know what you think about that, Rockford. About inflation, whether you think that's going to help.
So, I mean, the dollar amount value of your property may go up because our dollar's worth less, but I don't think it's going to be, just because the asset value, like you said, you've been a millionaire and had to ask for money, just because on paper it's there doesn't necessarily actually help you. Because if the banks become concerned, if the lenders become concerned, like, well, we think everything's a little bit overvalued and we got a contraction coming, they're not going to go 80% loan to value anymore or 75 loan to value anymore. They're going to pull back a little bit. They're going to say, well, we're only lending 65 now, right?
Well, and the problem is if the person's renting from you can't pay more rent, then the return just drops whenever the price goes up. Which, if you look at the rest of the world, that's pretty much the case. Their rent to values are so much lower than the United States. It just it's definitely a different. It just looks different because the rest of the world looks more like California, where your rents are $2,000 or $3,000 a month on $1 million house. The rents are just they aren't commensurate with the values. And that's more the place we're going, is to a place of the rents aren't going to be able to cover the amount of the cost of the whatever you're buying.
So what does that mean? The people that own assets now still own assets, and everybody who doesn't is toast?
Yeah, pretty much. And that's what we were talking about earlier is whenever they gave everybody money after COVID, all of that money trickled back up to the top 5 or 10%, because as soon as you give the bottom, really 50%, the ones that don't pay taxes, if you give them money as quickly as they possibly can, they give it back to us.
Mm-hmm.
I mean, they will spend that money, just like you said, your handyman. He goes out and buys a brand new truck. How fast could he give that money back to Ford or GM or Tesla? They can't give it away fast enough.
Yep.
They give that money. They get money in within a month or two. They've spent it all, and they've gave it right back to the upper class. And that's where all of the money, you talk about inflation, it's all going to the top 5 or 10%. And whether you give it to the bottom part or not, it's all going to trickle back up.
They don't go by assets. They go by doodads.
Mhm.
Like the cash flow game, right? It's a really great example of, I bought a boat in the game. It's like in the game you kind of recognize, oh wait, that really doesn't do anything for me.
It actually hurts me.
It hurts me. But in real life, they go buy that boat. They're celebrating. I got this boat. Boats.
But yeah, in real life, they do. They celebrate if they get the new truck.
Yeah, yeah.
But when you actually look at whether you're going to build wealth or not, it's the opposite of what most people do. And especially Americans, we're so bad about going for the short term, whatever we think is going to make us feel good, and we don't do what's going to help us long term. And that's the reason that inflation, like you said, is going to continue to go to the upper. I mean, it's moving farther and farther up the quintiles of wealth. And I
100% agree with you, and I think the proof is already in the pudding, and people are just calling it by a different name. Like, as soon as the interest rates residentially had a 6 in front of it, the market grinded to a halt. And every time I turn around, somebody's telling me, oh, actually asset values went up 4% last year or 3% last year. I'm like, okay, but there were 200 sales in a market that used to have 5,000 sales. Just because people aren't dropping their prices doesn't mean that their assets are still worth that.
Well, and part of that is private equity hedge funds that are continuing to buy those assets, driving up value just to get rid of their dollars, because they would rather own the assets than own the dollars, because they see what's happening to the U.S. dollar.
Well, and they're trying to create a self-fulfilling prophecy. I mean, they wanted interest rates up so that their cash value buying power went up. And now that they've had their fill, eventually they'll try to push rates down and pull all their debt out and, eventually pass it on to the consumer somehow. But, it's happening across the board. My tenants, they can't afford to, they just can't afford to do anything. I mean, it's crazy. They can't afford to breathe. And I can't afford to do anything. And that's the crazy part is, if you think about this, and I hope you won't take this as a self-righteous thing, because I don't mean it at all. This is an actual thought experiment. I sit in front of rooms like this, okay, and we represent the top 5% of society. Okay, the people sitting in this room, you look left and right, are typically going to be the top 5% of the economy, okay? No matter where you go, what state, these are the people that we're talking to. And I look at these rooms of people, and I look at how they're buying assets and how they're investing. And I know they're doing stupider things than I'm doing, because I talk to them. I know that the people in this room are being fiscally irresponsible. And I'm not. And I'm struggling. And I'm making less than I was making. Now, I never say somebody's making a ton of money or not a lot of money, because I've learned a long time ago that means something very different to somebody else. If I'm making under $20,000 a month, I say, I'm broke. I'm not making a lot of money. Some people are like, oh, I'm making money hand over fist. They're making $2,500 a month. I don't know. But what I'm saying is that think about how you guys are struggling, may or may not be struggling, okay, with insurance going up, with fucking HVAC costs going up. They're just filtering out a new refrigerant again just to steal more money from me. Property taxes going up, right? Like, think about that. And if you guys are the top 5% of society, how are your tenants doing? So just be cautious. Money printing is going to happen. If you're smart, you're thinking about how to take advantage of it. But if you sit around thinking that it's just going to come land in your bank account like it did last time, my flag planted in the sand is that you're going to be disappointed.